Corporate Finance, core topic 7, cost of capital. Learning objective number 5. We're going to compute the WACC used to compute NPVs for a project or an IRR hurdle rate. So let's talk about capital budgeting and WACC. Now WACC is the appropriate NPV discount rate and IRR hurdle rate for investment decisions as long as these two criteria fit. One, as long as the investment has the same business risk as the current firm. So what that generally means, it's in the same industry. So the idea of, say, Walmart just opening up another store would be an investment which you would think would have the same business risk as the existing firm. And two, that new investment has the same financial risk as the current firm. So if Walmart wants to open one more store, say a second store in State College, Pennsylvania, and they're going to finance it using the same DD ratio as the existing firm, then there's a good justification for just using Walmart's current WACC that we've calculated already. However, if it has different business risk, say Walmart wants to open up a bank or a pharmacy, then I wouldn't use the beta that I used when calculating the Walmart WACC, because that beta reflects mostly the risk of retail and food. Also, if that new investment is going to be financed all with equity or a majority with debt, then I'd adjust the equity and debt percents and beta for that capital structure. So let's look at how I do that for Walmart investments in 5 different areas. So we're going to look at Walmart adding one more store using the existing capital structure. In other words, they're going to build one more store in State College, Pennsylvania. It's going to look like all the other stores, and they're going to finance the CapEx using Walmart's DDE ratio. In other words, if Walmart is 20% debt and 80% equity, they're going to finance that store using 20% debt and 80% equity. And then and if that's the case, I'm just going to show you that I'm going to use the weighted average cost of capital. If Walmart wants one more store, but they're going to finance it with a little bit more debt or a little less debt, well, easy. I'm just going to de-lever the Walmart beta using their existing DD ratio, re-lever it based on that project's DD ratio, and then I'll also use that in the debt and equity, or debt percent and the equity percent used to calculate WACC. Third one, what if they want to add just another store, except it's going to be in India? Well, you'd expect that India has different business risks than the US, and so we're going to add something called a sovereign risk premium to the WACC. 4, Walmart's going to look at opening up a bank in every store. Well, you think a bank has different exposures than retail and food. So in that case, what I'm going to wind up doing is I'm going to take the bank unlevered beta, use that together with the DD ratio for this project and cost of debt for this project, and then calculate a WACC based on the business risk of banking. And then the last one, Walmart wants to install solar panels at an existing headquarters facility. What I'm going to suggest, one way of thinking about that is that project is risk-free as far as market risk goes. In other words, the stock market's up or down, this project's cash flows or energy savings aren't going to go up or down. So you can make a case that this is a risk-free investment. And many companies, a proxy for a risk-free corporate rate will be their after-tax cost of debt. So let's go look at these projects. So what I said is if Walmart wants another store, same capital structure, I'm just going to use WACC. So done. So I'm just going to use weighted average cost of capital for another store, same capital structure. If they want another store but a new capital structure, so they want to put another store in State College, but instead of financing it using, say, 83% equity and 16% debt, which is their current percent, they're going to finance it using a DDE ratio of 0.5, right? Walmart's current DDE ratio is 0.19. That new project also is going to have a cost of debt of 4% and a tax rate of 22%, maybe due to some local and state taxes as a different tax rate than the firm. So what I'm going to do, and I'm not going to go into the spreadsheet, I'll let you do that on your own. I'm going to come up with 543 and not 519, and here's how I'm going to do that. This new store is going to have a different capital structure. So the new store's DD ratio is 0.5. The existing DD ratio is 0.19. So this new store is going to actually have more financial risk than the corporation. All right, so what I'm going to do is I'm going to take the unlevered Walmart beta, and I'm not going to relever it based on 0.19. I'm going to relever it based on 0.5 DD ratio and get an unlevered, a levered beta of 0.77 for the project. I'm going to plug that into CAPM and get 659. Then I'm going to recalculate and to calculate WACC, I also need the D% and the E%, the percent financing and debt and equity. Now the current firm is 83 and 16%. However, with a DD ratio of 0.5, that implies a debt percent of 0.5 over 1.5, right? The DD ratio over 1 plus the DD ratio I talked about earlier. So it's actually going to be 1/3 debt, 2/3 equity. And then I'm going to calculate weighted average cost of capital based on my new KE, my project cost of debt, my new tax rate, and the projected debt and equity percents. And I get 543. The third, what if Walmart wants to open up a new store in India? All right, so it's going to be kind of the same business model. The store is going to be put in India. And you would think India has different business risks than the US. So one way of doing that is add something called a sovereign risk premium to try to account for the foreign risk. So the sovereign risk premium, I'm going to give you some more information here. Say that long-term federal sovereign rates for India are 450. US risk-free rate based on US treasuries is 195. If I take the difference, India borrows at 255% over US. So that must be accounting for some risk of doing business in India, or at least the risk of Indian government ability to repay on their bonds. So I'll just take that extra 2.55% that the Indian government pays on their bonds, and I'll add that to my KD, I'll add that to my KE, and I'll just recompute WACC. So basically I'm just adding the sovereign risk premium, the difference between the foreign countries' long-term bond yields, sovereign bond yields, and the US long-term sovereign bond yields, treasury bond yields. I'm going to add that 255 to KD and KE. Now the KE is going to be factored down by that tax rate, and when you calculate that new WACC, I'm going to demand a 7.64% return for operating in India, and that becomes my CAPM discount rate to decide whether I want to do the project. Fourth investment. Walmart wants to put a bank in every store. So you would think banking has different risks than retail and food. So what I'm going to do is I'm going to go back to that modern website, the one that had all the unlevered betas. I'm going to get the banking unlevered beta, which is 0.4. I'm then going to use the project's DDE ratio of 0.5. And I'm going to relever the industry unlevered beta for banking for the project's DDE ratio of 1.5, or I'm sorry, 0.5, 1 plus 0.5. And then, so I'm going to use a beta, a levered beta for this project of 0.6. I'm going to plug that into my cost of my CAPM cost of equity formula. I'm then going to estimate that that bank is going to have a tax rate of 27%, and the cost of debt is going to be 3.8 based on the project. And then I'm going to calculate the weighted average cost of capital for a Walmart's investment in a bank. Last project. They want to install solar panels at an existing headquarters facility. Now you think the main cash flows with solar panels would be the CapEx to buy the solar panels, and then will be the incremental, say, cost savings in electricity. Now you think this project's cash flows would not move with the S&P 500, with the market. It's uncorrelated to movements in the market. And if that's true, you can make a case that as far as market risk, which we call beta sometimes, the beta of that project should be 0. So this is a risk-free investment. So some firms, when they have investments like this, they consider risk-free. They would just use a proxy for a company's risk-free rate of return, and that would be the after-tax cost of debt. Just take the cost of equity times 1 minus the tax rate and use that, and that's 290. So that's actually a little hint for any of you people trying to request money from your corporate finance staff at work. If you feel your project is for, say, infrastructure in which the project is not going to have the same risk as the firm, I would argue that you need a lower discount rate because it's so safe, and maybe you get your project green light it. It's more likely you're going to get a positive NPV if you have a lower discount rate. However, I'm going to do a little caveat on this. It's a little controversial whether or not you should be using such a low discount rate for, say, replacing a roof or with solar panels or putting solar panels. And here's the argument. So again, the argument I used is this project's cash flows are independent or uncorrelated with the market, therefore it's risk-free, therefore a proxy for firm risk-free rate is after-tax cost of debt. But there's another view, and that view is, well, what is a firm? It's a collection of seemingly risk-free investments, right? So think about Walmart Superstore, right? What is Walmart Superstore? Well, it's a roof and it's a building and it's shelvings and it's cash registers and it's a parking lot. So it's just a collection of assets, and you can even argue that each one of those things is independent. But when you put it together and create a store, that has the risks of a store. So I'm not sure where I fit on this. I think I tend to go with the first view, that if you want to make an incremental decision to put the solar panel, that is somehow different than putting together a whole new store, and therefore it should use a lower discount rate. All right, so here's a summary. If you feel, or not feel, but if a project has a zero market risk, in other words, like that solar panel example, what you want to use is the NPV discount rate, and the IRR hurdle rate is you want to use the risk-free rate, which is, for a firm, they'll sometimes use the after-tax cost of debt. If an investment is in the same business, has the same financial risk, in other words, it's in the same industry, same DD ratio to finance that project, just use the current firm's current WACC. If it's in the same industry but just has a different financing DD ratio, just unlever beta, relever beta based on that different. Now be careful when you do that. You always unlever the beta based on the firm's DD ratio and then relever it based on the project's DD ratio. And then to calculate the WACC E% and D%, use the project's DD ratio. Now if you're in a different industry like Walmart and banking, but you have the same DD ratio, same financial risk, just use a proxy industry beta and lever it based on the project's DD ratio. In this case, it's the same as the firm. Or if it has different DD ratio than the firm, just use the project's DD ratio. And if it's a farm project, one simple, crude thing to do is just add a sovereign risk premium to KE and KD and recalculate WACC. So here's a little note. This note's actually going to help you with the case study if we're doing Burton this year. How to come up with a WACC of a private or a small firm. Well, private firms don't have the required WACC parameters. They may not have a stock beta. They may not have a market DD ratio because they don't have a stock valuation, market price. It'd be hard to get cost of debt. So how can all of these be estimated? Well, let's look at each piece. Beta. How do you get the beta of a private firm? Well, we'd use that industry beta. Easy, right? Just find the beta of the industry. Another way to do it is very close to that idea, is just use the beta of the most similar firm. So if, say, Walmart was private, I would just take the beta of Target and just use Target's if I didn't have the industry beta. DD ratio, that's a tough one, and this, I think in the case study it's going to come up. What if there's a private firm, so you don't really know the market value of the debt? So how can I get a DD ratio to plug into WACC? Well, you could argue that I'm going to use an industry average DDE ratio, because in the long run, many firms take on the risk characteristics and the DD ratios of their industry. Similarly, you can use another firm's DD ratio that's more mature. Also, if it's a firm that has a market value DD ratio and they're looking to take over a private firm, you can make an argument that just use the acquirer's DD ratio, since the acquirer's capital structure is going to be what's important after it takes over the target firm. Cost of debt, well, you could use the accounting interest expense You could use, say, the rate on current bank loans. So there might be information that the firm can currently borrow at X percent. Or you can find the cost of debt of similar risk firms. So try to find firms that have maybe similar levels of debt or similar business risk, and just use their cost of debt. And the last thing, small stocks, or it's really small companies. So here's a problem I have. Say I'm trying to value Walmart opening a store in State College, Pennsylvania, and I come up with the Walmart's weighted average cost of capital, and I use an industry beta. But what if a small business tries to launch a Walmart-like store in State College, Pennsylvania? It sure feels like that would be much riskier. Call it Bobby's Mart, whatever you want to call it, some independent retailer, even if it looks exactly like a Walmart, it just feels like that is going to be riskier. This new firm, it's got brand issues it has to overcome. It maybe doesn't have as deep pockets. If there's a downturn, it may not be able to survive. So these smaller firms, even if they're in the same industry with the same DE ratio of a mature firm, you would think have just more risk. So for that reason, many will add an extra risk premium to small firms or private firms. And what you could do is just add, say, on average, say 2 to 4% to the mature firm WACC. So if I were trying to think about deciding whether I want to buy some independent retailer that kind of looks like Walmart, but they're not Walmart, and I want to decide if I want to buy it, so I want to calculate the NPV of the cash flows, I'd probably use Walmart's WACC, and then I'm going to add, 2, 4, 5, 6% to Walmart's WACC, and I'm just going to call it kind of a small company risk premium to add to it. So in this topic, we calculated WACC, or the discount rate needed to look at all kinds of projects, ones with the same and different business or financial risk as the existing firm.